Hello everyone. Gold prices in recent times have continuously remained at very high levels, even reaching moments where many investors feel that gold can only go up and never come down. But is that really true? And if certain factors occur, could gold prices actually collapse very sharply in a very short period of time? In today's video, we will analyze the downside of gold, something that very few people talk about, especially when the market is in a euphoric state. First, let's look at the current context. Gold prices are being supported by many factors. Real interest rates remain at a rather sensitive level. Global investors are still searching for safe haven assets, and most importantly, geopolitical uncertainties have not fully subsided. Because of these reasons, defensive capital continues to stay in gold, helping this precious metal maintain its momentum. However, we need to remember that financial markets do not operate on emotions, but on expectations and data. So, what are the scenarios that could cause gold prices to reverse sharply? The first and most important factor is that the U.S. Federal Reserve, the Fed, could change course. Imagine if the Fed decides not to cut interest rates as the market is currently expecting, or even sends more hawkish and tougher signals regarding monetary policy. Immediately, U.S. government bond yields would surge, and the U.S. dollar index would strengthen accordingly. At that point, the opportunity cost of holding gold, a non-yielding asset, would increase significantly. Investors would tend to sell gold and shift toward holding dollars or bonds to benefit from higher yields. This is the most dangerous scenario for gold prices. The second factor that could sink gold prices is inflation falling faster than expected. We must acknowledge that gold thrives on fear of inflation. When inflation rises, people buy gold to preserve the value of their assets. But what if key economic data, such as the Consumer Price Index (CPI), the Personal Consumption Expenditures Index (PCE), or the Purchasing Managers Index (PM), all show that the U.S. economy is cooling in a controlled manner and inflation is declining rapidly? In that case, demand for defensive assets would decrease significantly. Gold would lose its main reason to stay at such extremely high price levels, and a correction would be hard to avoid. The third factor is the easing of geopolitical tensions. History has shown that gold always rises strongly whenever conflicts escalate or the risk of global instability increases. Fear-driven capital flows into gold as an absolute safe haven. But on the contrary, if peace negotiations show positive progress, parties find common ground, and global risks decline, smart money will immediately exit gold. It will no longer stay in a defensive asset, but instead flow into riskier investment channels with higher return potential, such as the stock market. At that point, selling pressure on gold would be very strong. And the fourth factor, a psychological one, but extremely dangerous, is mass profit-taking by investors. Let's take a look back. Gold prices have risen too quickly in a short period of time. This has created a strong FOMO mentality, or fear of missing out, within the investor community. Many investors have chased prices at high levels, causing long positions to become overcrowded and the market to lose balance. In such a state, the market becomes extremely sensitive. Just one small piece of bad news, or even a rumor, can trigger a massive sell-off. One person sells, dragging others along, creating a devastating domino effect. Gold prices can collapse very quickly and very deeply, leaving those who bought at the top completely unprepared. So, what is the worst-case scenario that could happen? Imagine if 2 or 3 of the factors we just analyzed occur at the same time. For example, the Fed turns more hawkish, while data shows inflation is falling rapidly and the U.S. dollar strengthens sharply. This would be a perfect storm for the gold market. Gold prices could break key technical support levels and enter a very strong short-term correction phase. And of course, those who bear the greatest risk are the investors who chase prices at the top due to FOMO. So faced with these scenarios, what should investors do? The most important reminder is this: gold is not bad, but buying gold at the wrong time is the real problem. The first principle is to never FOMO. Don't buy just because you see others buying at any cost. Second, never all in, meaning never put all of your capital into gold, especially at high price levels. Always diversify your investment portfolio. And finally, most importantly, always prepare a worst-case scenario. Ask yourself, if gold prices drop by 10% or 20%, what will you do? What is your action plan? The market always provides opportunities, but those opportunities are only for people who are patient and well prepared. These are my personal views, based on an analysis of possible factors, for reference only and not investment advice. Everyone should conduct their own thorough research and consider their personal risk tolerance before making any buying or selling decisions. What do you think about this video? Please leave your personal opinions in the comment section below. If you find this video helpful and valuable, don't forget to like, subscribe to the channel, and share the video to support us in creating more high-quality content. Thank you very much for taking the time to watch. Goodbye, and see you again in the next videos.